Hey guys, Capital Cosm here. Before we start this video, I just want to let you know that I believe that we are on the cusp of a major uranium bull market. Now, these things don't happen every other week. The last uranium bull market peaked in 2007, the one before that in 1978. So when these things happen, you've got to take advantage of it. And how explosive are they? Well, you've all heard the stories. Uranium skyrocketing from $10 to $20, all the way up to $150 in these uranium bull markets. Where will it go this time around? Well, we don't know. We'll see. But you've got to take advantage of the opportunity. What better way to do that than to leverage Justin Hune's Uranium Insider newsletter? You get access to his monthly newsletters, his webinars, his stock picks, his portfolio, all of that stuff. You get access to guests that you may not see on YouTube. You get access to having them ask questions that you may not see anywhere else. So I highly recommend, if you're going to take part in this uranium bull market, you check out Uranium Insider. Link is down in the description box below. Be sure to click the link. There's quarterly plans, there's annual plans. So if you're kind of tepid, you're kind of hesitant, you could always go with the quarterly plan. Kind of test things out, sample things out, see if you like it or not. But the way I see it, guys, you know, you've got to pick the right stocks. A lot of these uranium companies are not going to make it to the other side. Now, and Justin Hune's uranium portfolio has outperformed the likes of URA by a significant margin. Since 2019, it's up 5x from where it started. So click the link down below and we'll get started right now on the video. Thanks, guys. So the Fed signaled that a couple days ago that they were done hiking rates, and we're looking at 3 additional rate cuts, maybe 3 or more rate cuts in 2024. The yield curve is showing otherwise. The yield curve is 10 years down below 4%. I want to tie this with the fact that a lot of people like to compare Powell with, or want to compare Powell with Volcker, but Powell's dealing with a much different deck of cards. For one, tying it back to the energy portion. Energy was a lot easier to extract back in the 80s, and so it's like the toothpaste tube analogy. It doesn't really take much to squeeze toothpaste out of a brand new tube, but the more you use it, you got to leverage more effort to get that remaining toothpaste. But so back in the 80s, energy, there's a lot more cheaper. There's cheaper energy. EROI was a lot higher than it is today. And so energy is correlated with productivity, with GDP, essentially. You map energy production with GDP. There's a very, very, very tight correlation. And so that's not the case today. And so where am I getting at with this is the debt burden, increasing the debt burden to the extent of having 33 trillion some odd dollars in debt. The energy isn't there to extract productivity out of to service the debt burden. Essentially, you could grow your way out of it in the 80s with 15% interest rates. Today, even at 5%, given current capacities, that doesn't exist. So I kind of want to get your take on that. Is what really can the Fed do? Can they continue raising interest rates, or was a cut simply inevitable?
So I've been saying for a long time that any hike is going to be temporary and abortive, and depending on how much they push it up and how long they hold, that's going to determine the magnitude of the crisis that they precipitate. That we're in a falling interest rate trend. The drivers for that falling trend are in full force and effect. One thing I want to say about, I want to go into a little rant about growing your way out of the debt. And I know this is really popular, and I've had discussions with, let's say, Stephen Moore at a conference once, and he's a big proponent of that idea. People should be, anyways, let me take a step back. There's a way of measuring whether that's possible or whether that's ever actually occurred. So conceptually, people struggle with things like the rate of this is changing at a certain rate, and the rate of that is changing at a certain rate. So in physics, you have distance, you have velocity, you have acceleration, you have jerk. Each is a derivative of the previous. So velocity is change in distance per time. Acceleration is change in velocity per time. Jerk is change in acceleration per time. People really struggle with that unless they have the math and the physics background. So, they say, well, conceptually, if we were growing GDP faster than we were growing debt, but they can't really frame it in something slightly more, rigorous. But economics actually has done. There's a concept called marginal productivity of debt, which is exactly that. How much fresh GDP juice do you get, for each new dollar of debt that you add to the, squeeze? And, that's not hard to measure. This is an economics concept that's been around for a long damn time. If you Google it, you will see my name and my articles dominating page 1. That really, okay, I'm pleased, I'm tickled pink that, I'm authoritative on this topic, but that's really, I have some prominence as an economist. I'm not nobody, but, I'm not that prominent. The reason why I dominate all that is because nobody more prominent dares talk about this. It's not that they're not aware of it. They all got this in their economics education, I would presume. It's just, it tells a picture that they don't want to tell. So if you plot marginal productivity of debt, and the data series that I've been able to find, but you can't get that directly, but you're looking at GDP and you're looking at debt, and you can calculate it pretty easily. Never been able to find data that goes back prior to 1950 about it. Marginal productivity of debt has been falling since 1950. And there's zigs and zags along the way, but it's been a falling number. And so what that means is, even during the so-called gold standard we had at that time, up to 1971, during Republican presidents and Democrat presidents, Republican House, Democrat House, Republican Senate, Democrat Senate, and every possible combination of the above. Recessions, booms, busts, you name it. It's just not been true that we're growing our way out of it. The problem is getting worse. It takes more and more and more debt added to get less and less GDP juice added. And so I've written one article talking about a concept that I coined called the heat death of the economic universe. So this thing keeps falling. That means you have to do more and more debt added to get less and less, basically to stay even, and you add a little bit of GDP, but less and less GDP. What happens when that falls below 0? Now you're adding more debt and GDP is contracting. And not only does it take GDP to service the debt, GDP is the gross revenue. You actually need net profits. Right? So if you're a big company, you're generating $1 billion worth of revenue, that doesn't tell you anything about your ability to service the debts. Right? That is, net profits is where you service debts out of. And net profits would be a much smaller number than GDP, and growth in net profits would be a much smaller number than growth in GDP. So when you get to the point where the net profits can't sustain it, even the debt service, what happens is the interest rate has to fall. And the way that manifests, we're talking about incentives. Suppose I have a business generating 4% return on capital, and they lower the interest rate to 2%. Well, I borrow more because I can make more money. Go into deeper debt, yes, but I'm making a positive spread. I'm borrowing at 2 and making 4. Then they hike their rate, the Fed funds rate to 5.5. My borrowing cost suddenly goes up to 8, but I'm only generating 4% return on capital. What am I going to do? Well, first thing is stop borrowing more. There's no case anymore. And secondly, I have to find capital assets to sell. I have to shrink my balance sheet. I have to reduce the amount of debt that I have to service at 8% and shrink the business. There is no demand by business for credit at these rates. After 40 years of falling rates, the only time there was any demand for credit is on a downtick in rates. Certainly not when rates stayed the same, let alone tick up. And now the Fed has pushed them up, plus 5% compared to where they had been in February of 2022. So gravity is pulling this down. So there's an integral tie between rate of return on capital across the economy, between marginal productivity of debt, between debt service or ability to pay interest and demand for credit, and ultimately the interest rate. They're all tied together. And the whole complex is sinking. We're not dying in the hot death of thermonuclear explosion and hyperinflation. We're dying the cold death of sinking below the waterline, drowning. We're drowning in this debt. And our ability to service it is becoming harder and harder. And with that, there's, demand for credit is more and more lethargic. And, the Fed, I don't know exactly what signal they're looking at. I don't think the Fed cares about GDP. I don't think they care about unemployment, and I don't think they care about the stock market. What they care about is bank solvency, the crony banks. And if you see, massive credit defaults coming, that is going to wipe out the banks. So the Fed is trying to be, proactive, right? So the difference between the Fed today, and the Fed in 2006, 2007, the Fed today would say that the 2006, 2007 Fed was asleep at the switch, that they were negligent, they didn't get it, they missed the boat, and by the time the crisis was upon us, the Fed was doing too little too late. And so today's Fed is trying to be, I call it hyper proactive. They want to see the first sign of anything and they want to jump all over it. And so they're seeing some signs. Meanwhile, we've had an inverted yield curve for how long? Right? There's no demand for credit at the long end. And despite the Fed trying to push up the interest rate at the short end, which they control by diktat, they don't control the 10-year, Treasury bond. And there's no demand to issue more bonds. There's no demand for more credit. And so that's what that's telling you. And so we're reverting back to the falling trend, which is still in full force and effect, and it's going to return with a vengeance. Is this it right now? I can't tell you the timing of it, but I can tell you, yes, that's absolutely inevitable. It's a matter of time, and is the time right now? It looks like that, but I wouldn't want to stake my reputation that yes, it's February, you're going to see the first rate cut, maybe.
Yeah, it's really interesting too. We're starting to see a lot more of these crises within a smaller time frame. So the distance between each crisis is getting tighter and tighter, and it kind of goes back to what you just said about the marginal utility of debt. You're out on you're in the middle of the desert. That first drop of water is invaluable, or that first cup of water is invaluable. The second cup of water is a little less valuable. The eighth cup of water, well, it pretty much drops off in value.
Right.
And it's we just heard from John Williams today. He said, "Oh well, we're not talking about any rate cuts for 2024." Yeah. So it seems like they're trying to walk it back a bit because as soon as the markets heard the news, gold shot up like $50 in like an hour. I don't know if you saw that. All these liquidity metrics or assets like Bitcoin and so forth, they also shot up at the news.
I'm just going to interrupt there. I'm not a big follower of what I call Kremlin watching. Yeah. Trying to figure out how fat Alan Greenspan's briefcase is and what that means, or whatever. Looking at the Fed dot plots, but I did read that the Fed dot plots, most of them were showing a lower Fed funds rate in 2024. So strictly speaking, he's lying. That the Fed actually is talking about lower interest rates, and they put it on their dot plot. I mean, that's just black and white, right? I mean, what am I missing?
Yeah. No, it's just really interesting. You hear two contradicting statements from the Fed. One day you see, like your point, you see the dot plots all signaling rate cuts in 2024, and then John Williams comes on comes on CNBC or whatever talking head show he comes on. He says, "Oh well, don't believe your lying eyes. We're not expecting any rate cuts for 2024. Don't look behind the man behind the curtain." So it just shows how politicized and all this entire concept of having to wait and see what a committee decides on when it comes to something as pertinent as interest rates. It's having a central bank is one of the tenets of Marxism. And, we don't live in a capitalist society. We live in a very controlled environment.
And people
waiting at the diktat of central bankers.
Even the otherwise free marketers absolutely defend why you couldn't really have a free market in credit, why there has to be an irredeemable currency forced on us by legal tender laws and a central bank to dictate the interest rate. And the only real debate, even amongst the otherwise free marketers, is whether the Fed should centrally plan our economy based on inflation, or versus whether the Fed should centrally plan our economy based on GDP growth. And that's the Overton window, right? Who was it who said that you want to control the people, you allow a very vigorous debate, but you totally control the spectrum of the range of what's allowable in that debate.
That's Stalin. Like you control your opposition or something to that degree.
Yeah, and the quote I'm thinking
Stalin or Lenin, or one of those guys.
But it was basically, by controlling the acceptable range of what's debatable. And if you say, look, I don't think there's, people say, well, what's the right move for the Fed? Right? There is no right move. Whether they force interest rates up, whether they force interest rates sideways, or whether they force them down, that none of them are the right move, and they can't even know. Right? This is Hayek and Mises going back a century. It's not possible for them to even know what the right rate is.
Yeah.
And I've done some work showing that even if you know what the right price is as a central planner, the way in which you cause that price to come about is quite different than the market processes that would result in that price in a free market. And so you're not actually achieving the same outcome, even if you achieve the same nominal price at that moment in time. You're not doing it the same way, and therefore you're not getting any of the goodness of the market pricing mechanism. So they can't get it right. And so everything becomes a false alternative. Should the Fed be independent, i.e. unaccountable, or should the Fed be accountable, i.e. politicized? Should the Fed be trying to render your neighbor unemployed to reduce your unemployed neighbor's ability to compete with you to buy groceries, and therefore you get lower grocery prices? Or should the Fed be supportive of asset prices and business activity? All false alternatives. A free market doesn't think that way. A free market thinks, am I willing to lend under these terms and this interest rate? And if I'm not, I pull my credit, and okay, the interest rate is to tick up. And the same thing, right? If the grocery store, you walk in and they're charging $500 a pound for meat, well, you're not buying meat that day. That forces the price to tick down because they have to sell the meat. And if they can't sell it at 500, well, they'll try, obviously I'm making a ludicrous example. They'll try 490, they'll try 450. They'll keep marking it down until it sells. And then you find where the actual price of meat is, which is a hell of a lot less than that. And, imagine if we had a Politburo, we had a GOS plan for meat prices. Well, should we raise the price of meat to encourage people to lose weight, or should we lower the price of meat to encourage job creation in the cattle ranching sector?
Yeah, there's no committee out there that's going to outmaneuver the free market of ideas. You're essentially, even if you have like people with 200 IQs and are most well-read in terms of economic theory and so forth, those people, they're competing against 8 billion nodes within a neural network that are seeking their own self-interest. And there's just way too much complexity, even for the smartest human being out there, to outcompete that entire neural net.
And I don't think the socialists really believe that the central planners are smarter anyway.
I'm just saying, hypothetically, like if they were like 200 IQ, yeah.
What the socialists really want, obviously, is control, and that's it. The control is an end in itself. There was some famous interaction where Saul Alinsky was teaching some sort of class, and was saying, well, what's the point of getting into power? And somebody in the class said, so we can do good for the poor. He said, no, the goal of power is to exercise power. That's what they want. They want to. The whole point of socialism is to politicize decision making, so that you have favors you can dole out to your cronies and get more power. That's what this is about. Does it work? No, of course it doesn't work. Socialism never worked, and that never seems to deter the socialists from asking for more. So this, as you said earlier, this lady from Ireland talking with the COP minister from UAE, and she was like, yeah, but we have to fix the climate. Really, what she's saying is we have to give us more power. So we can then ration and say, well, you get to drive your car today and you don't. Or you get to own a car today and you don't. And you get to ride the train today and they just get to bestow based on whatever criteria they want to set. If you look at totalitarian dictatorships, they have things like internal passports. China has the social credit system, and there was kind of a bit of a scandal. One of their top Olympic athletes had said something that was a no-no. So they didn't arrest him or whatever, but they said, you don't get to take the high-speed bullet train to come to the Olympics. So when everyone else could get there in 3 hours, he had to take all these slow trains, and it took him 2 days to get to the Olympics. That was his punishment for saying something that was politically incorrect. That's the whole purpose of all this, is to get people to be cowed and browbeaten into into submission.